I'd like to spend a little time to talk about growth. In the last few lectures, we've been looking at various ratios, and growth actually could be considered a ratio. We see the destructive effects of unrestrained growth at the same time as we see the benefits, where escaping from poverty for everyone is now within our grasp. In a previous lecture, I mentioned that the default goal in finance is maximizing shareholder wealth. That goal pushes managers to pursue profitable growth. So if we as a society believe that unrestrained growth is destructive, the only way to incentivize managers appropriately is to design policies such that social costs are put into the cost structures of firms. Responsible managers will respond appropriately and growth will be tempered. That means that responsible managers should be in the forefront of measuring the social costs of their actions, and so that they can help craft policies that allow this internalization of economic externalities. There was a recent article that McKinsey published by three of its researchers that had the title Grow Fast or Die Slow. The article was written about the software industry, and the researchers came to the conclusion that in the software industry, if over the last 30 years companies did not grow fast, then basically they were highly at risk and likely to die. The reasons for this in software is that there's very low barriers to entry. Patents in software aren't worth very much because they can be easily circumnavigated. There are massive economies of scale and there is substantial brand recognition, so a firm needs to grow quickly to achieve that recognition and those economies of scale. This may or may not be true in other industries, and an analyst has to analyze the effects of growth and the industry structure in order to determine what the appropriate growth rate for a firm is. I've been talking about growth rates, so let's put it in numerical terms. The appropriate growth rate to use is the compound annual growth rate. CAGR converts multi-year into a standard annual compounded growth rate. And one calculates it simply by taking a price relative, the end period value divided by the zero period value, and raising it to the power 1 over n, where n is the number of year periods, and then you subtract 1 from that. Obviously, if x0 is reduced to near 0, then the compound annual growth rate explodes. A second related problem is if the variables go through 0 during the period. So if they switch from a positive to a negative value or from a negative to a positive value, that means that the growth rate at some time has gone to infinity. And finally, if the values are small relative to the other accounts on the income statement or balance sheet, then even if the compound annual growth rate is high, then it might not be very important. For Sinopec, calculate the 2-year compound annual growth rate, and as you can see, what we do is simply take the last year, 2014, divided by the first year, and raise to the power 0.5 and subtract 1, giving us a very low growth rate, a 0.7% annual compound growth rate in revenue, and when you bring that together with an increase of 13.1% in depreciation and amortization and depletion, then that translates into a negative earnings. Going to the balance sheet, one can see that total assets are growing at a compound annual growth rate of 8.7%. Here you can see a positive 40% per year over the 2 years. But since both of these are negative numbers, what we're seeing is an increase in the negative amount of the working capital requirement, which is financing much of the growth in fixed assets. What about Roche? We have 4 years of data for Roche, and that means that our compound annual growth rate is calculated by raising the price relative to the exponent 1/3. You can see that for Roche, sales are growing only at a slow 3.7% per annum, although royalties are growing at 15% per annum. These represent only about 5% of sales. The fastest growing item on Roche's balance sheet is intangible assets, growing at an average 36% per annum. Not only is it growing rapidly, but the number is large relative to other non-current assets, being exceeded only by property, plant, and equipment. What are these intangible assets? These are the purchases by Roche of patents and the development internally through research of patents. Unlike the software industry, patent protection in pharmaceuticals is actually very strong. These form key barriers to entry for Roche in allowing it to enjoy profitability. I want to introduce a new concept, the self-sustainable growth rate. The self-sustainable growth rate is the rate at which the company can grow if new equity comes available only from retained earnings. So the firm does not tap any equity markets. The firm grows through the retention of earnings, and then it adds short-term and long-term debt in the same proportion as the new equity from the return on equity, and so debt grows at the same rate as equity. So if we have the company with a capital structure like this, and if the company grows by 10%, that 10% growth will have to be supported by a growth in assets. So let's assume that it needs a proportionate growth in assets to support that. So cash, working capital requirement, and fixed assets all grow by 10%. And then that has to be financed. If the capital structure is to remain the same, short-term debt and long-term debt also have to be increased by 10%, and equity also has to go up by 10%. That 10% equity increase has to come from ROE. If ROE is 10%, growth is sustainable without dividends. If ROE is 20%, growth is sustainable with 10% of the returns on equity being paid out and 10% being retained. So if the payout rate is 50%. That's the idea of the self-sustainable growth rate. In general, sales need assets to generate the growth. A cash cushion for liquidity, a working capital requirement, and fixed assets, property, including intellectual property, plant, and equipment. A default assumption, that is to say a good starting point assumption, is that growth in sales requires a proportionate growth in assets. Of course, if the company has massive economies of scale, as do some software and network-based firms, this assumption may be wrong. But let's keep it for the moment. Let's also assume that tapping equity markets is difficult and that the firm wishes to keep its current capital structure. In this case, the self-sustainable growth rate can be calculated as the retention rate times the return on equity. The retention rate is simply the earnings per share minus the dividends per share divided by the earnings per share times the return on investment. Let's look at Roche's self-sustainable growth rate. The retention rate is about 28% in 2014, having dropped from 40% in 2013. These low retention rates, though, are multiplied by very high returns on equity, so the self-sustainable growth rate ranges in the 3 years that we have data for from 14% to 28%. And this self-sustainable growth rate is much higher than the compound annual growth rate in sales or the compound annual growth rate that we see on the balance sheet, giving plenty of room for Hoffmann-La Roche to delever or to expand if it wishes to do so. Let's turn to Sinopec. It had retention rates of 57%, which dropped to 39%. Its return on equity was relatively low. So when you multiply through the retention rate times the return on equity, we find a self-sustainable growth rate ranging from 3 to about 7%. Now, that self-sustainable growth rate actually exceeds the growth rate in revenues, but if you look at the growth in assets on the balance sheet, you can see that growth in assets exceeded the self-sustainable growth rate, which leads one to believe that Sinopec has to either increase its leverage, that is to say its debt-equity ratio, or seek external financing, or in future reduce its growth rate. That brings to a conclusion the points that I wish to make about growth. Obviously, growth can be critical to the firm. Analyzing the financial statements using compound annual growth rates is very easy, and it can help the analyst gain insight into the firm. Sustainability of growth should be analyzed. Growth needs financing, and financing is expensive, so calculating a self-sustainable growth rate is useful. And within public policy, growth has implications for sustainability of the economy and of the environment. Managers of the firm, even though they're constrained to maximize the wealth of shareholders, have a duty to help the construction of public policy to enable sustainability at the macro level.